Louis? Yes, you just introduce yourself to
Well, I'm Louis Hagen. I'm the executive director of the FDIC, the German Association of Pfandbrief banks. And as you have mentioned, they have been around for quite a while. And I think the experience that we have had all over Europe is that covered bonds really provide a very crucial and essential source of liquidity for the banks. And this is especially in times, difficult times, stress times. Well, the regulators are, I think, very important for covered bonds, and everyone needs the support, some systemic support. So, having had this great experience in Europe, do you expect that you will consult with European regulators on this question?
I think we absolutely should engage in discussions with them. They've obviously gotten a high level of comfort in this market, and I think yes, we absolutely can learn with how Europeans approach the product. And I think we'll probably have a few discussions at that level, and we can certainly open to for the discussion like
Any other further questions here? Actually, if I could just ask one of Louis, since it's pertinent, is it true that the BDP obtains some legal opinions according to this article that suggests that in the event of liquidation it's highly likely that there will be delays in payments for outstanding US covered bonds?
Well, there is no legal opinion on this specific question, but you know that German mortgage banks or Pfandbrief banks, they are active in the American markets, granting mortgage loans, and since these mortgage loans are, should be in the case of insolvency of the issuer, they must be protected for the bond holders, and therefore we looked into the question: what happens if the German Pfandbrief bank goes insolvent, and the cover pool administrator will then he will then manage the cover assets, the cover pools, and in these cover pools you will have American mortgages on properties here. Therefore, we have to look at the question: are they really protected, or is it possible that another creditor of the bank will try to possess these properties which are in the cover pool assets? And that's the question which was raised, which we answered or tried to answer through this legal opinion. And in the legal opinion, then it is stated that the FDIC has a very strong position when it comes to an American legal entity, which you have here. And it might happen that the FDIC will not allow that mortgages or assets of the bank will be reserved to specific creditors. If you want, to save the bank, if you want to rescue the bank, the FDIC may say, well, nobody may touch these assets because the bank needs these assets to continue, their operations. And for the German Pfandbrief, it's not a problem because the mortgages are on the balance sheet of the German bank. But if it was a U.S.-based credit institution, then the FDIC has, I think, a very, very strong role that you play in case of threats of an issue. And so we don't have specific legal opinion on the question.
Well, I'm not sure. I'd like to read the legal opinion. I'm not sure I would agree with the description of our process. If the mortgages are collateralized in the covered bond, they are there to support the covered bond. And in terms of increasing the resolution cost, that's the one of the things we look at, because the assets are not there to support the resolution process. They're there to support the covered bond issues. So On Master Debt's perception, I know there is the issue of our ability to, there's a 90-day stay, we're given 90 days basically whether to perform or repudiate, and I know that is, I understand, this is something I'd really like more information on. This increases the cost of putting deals together because we have to earn interest on transaction to cover the interest payments along that potential 90, I guess you got 120 days disruption in interest payments. So I would really be interested in knowing the additional cost that causes for these deals, if there are any other ways that this 90-day stay provision or resolution procedures in general increase the cost. But in terms of the mortgage assets, Mike, you correct me if I'm wrong here, but the mortgage assets are there to protect the covered bond offering. I don't think that's an issue. Perhaps I would like to get the legal opinion and a little more information on how much additional it costs to put deals together because of the 90-day stay issue. I think that would be very helpful in our considerations. And I think a lot of things maybe from the communication there about how procedures work and how they don't work.
We'll send you.
Okay, great. Thank you.
Right, I think we need to move on to the next panel. So thank you very much indeed, Sheila, for that, and welcome your comments